While the S&P 500 is barely down 4% from its all-time high, many growth stocks are down 30, 40, 50, even 73% from their all-time high. So I've personally been taking advantage of the dip on a lot of the growth stocks. I did buy the dip on 2 of my growth stocks in my portfolio. I'm going to talk about them. I believe they're presenting an amazing opportunity at this price, and maybe the market will be up a little bit tomorrow. They might be up 2 or 3%, but my thesis will still be the same, and I still believe those stocks are presenting a great opportunity. So I really hope you enjoy it as always. The first one is SoFi. SoFi is down about 22% from its all-time high. It's been a quick, brutal sell-off on the company, and I believe this is the state of most investors in the market, where at $32, they looked at SoFi. They said, I'm an idiot. Why didn't I buy SoFi? It made so much sense. It's a bank. It's growing. It's not too cyclical. Why didn't I buy SoFi? But now SoFi is trading at 25, and people say, I'm not buying this shit. Like, I'm not buying this trash company, and it's going much, much lower. And it could go lower. I think that would be fair, maybe $21, $22. But I think it would be a mistake to try to time or try to, in my opinion, ignore SoFi at this price. Now, many of you guys might be confused because I posted a bearish video on SoFi like 3 weeks ago, and I got a lot of hate. But I'm personally could be bearish and bullish on the same stock at the same time, dependent on the valuation. So I'm a big believer in not overpaying for something. If something is overvalued, I'm going to trim it, or maybe I'm going to sell it if I believe the market is giving me 5 or 10 years worth of returns. But I did buy back my SoFi stake, and I believe it's extremely undervalued, or you could say undervalued at this level. Now, SoFi has been growing members exponentially from 2.9 million members to around 12.6 million members as of the last quarter. This is absolutely amazing. And many of you guys might look at 12.6 million and you might believe, oh, that's a lot of members. So maybe SoFi doesn't have any kind of long runways left. But the total US population in the United States is about 260 million people. So SoFi doesn't even have a 5 or 6% market share. So the 12.6 million is really nothing if you look at it from this perspective. And I don't see why SoFi isn't going to have, at least in my opinion, 10, 15, even 20% market share over the very long term. As a lot of the younger generations, they love the fintech banks, they love online banks in general, and that's just in the United States, not counting if SoFi potentially expands internationally, which could be very, very possible. And again, I love the runways with the business, and it's still really, really early for SoFi. Revenue growth has been re-accelerating to 38% versus 26% in 2024. That's something that doesn't happen very often, and I'm very happy to see it. Adjusted EBITDA has also been re-accelerating. Adjusted net income is also looking a little bit better with 15% net income margin. I think over the long term, they can achieve 25, 30, maybe even 35% for the company. And I think you can achieve that by paying more attention to the fee-based revenue mix. Fee-based revenues now make up 43% of SoFi's revenues in terms of lending. And this is key because SoFi is trying to transition to more of a capital-light business model. So instead of them having to take on the personal loan risk whenever you're applying for a personal loan, they take the loan they originated for a third party like Blue Owl Capital. In this case, Blue Owl Capital is the one that's taking the credit risk in case you don't pay. SoFi is collecting like a commission or origination fee for hooking you up to Blue Owl Capital. And they also collect servicing fees whenever you're making payments through the SoFi platform or the SoFi ecosystem. So this is absolutely amazing. It's going to reduce the risk of the company. They still hold some loans on the balance sheet, mostly the good ones. And the ones they don't like a lot, they send them to Blue Owl Capital and they collect commissions on it, which is absolutely amazing again. In terms of their guidance, they put up 37 cents. It was 31 cents last quarter. And in Q1, it was like 28 cents. So this is insane. And I would not be surprised if they end the year about 41 or 42 cents in earnings per share for 2025. Now, there's many catalysts for SoFi for 2026, massive catalyst. And the first one is crypto. SoFi will be the first national bank to let customers buy, sell, and hold crypto. This is a game changer, guys, because if you look at Robinhood's mix of revenues, a decent chunk of Robinhood's revenue is coming from crypto. So SoFi is growing 38% in revenues without even implementing crypto or no crypto trading fees. And to me, this is insane. And imagine the upside whenever SoFi implements crypto. So I believe this is amazing for the company. The company could potentially also join the S&P 500. Many stocks like Robinhood, which I own, have joined the S&P 500, and SoFi is one of the few left. It's qualified. It could happen as soon as December, whenever they make the decision again. If not, it could potentially come in 2026. And I think SoFi joining the S&P is not if, it's mostly of a when problem, this year or next year or late next year or 2027. And I believe this is going to be amazing. Now, something else that I look at for the long term is the top 10 or 20 banks. And I see names like Citigroup, names like US Bank Corp, names like PNC and Truist and TD and Capital One. Those are massive banks, and I'm not comparing SoFi to them. But I personally not seeing why SoFi would not be in the top 15, 20, 25 banks over the next 10, 15 years, over the long term. As a lot of the younger generations, they love those online banks, or you could say fintech banks in general, and more money is going into them, and it's coming out of traditional banks like TD and PNC and all these kind of banks. So I'm not saying why SoFi is not going to continue taking market share alongside Robinhood, and I'm not saying why it's not going to be in the top 10, 15, 20, even 30 banks, which would be amazing for the company. Now, for 2026, I'm seeing 28% on the upside, and over the next 5 years, I'm seeing much more upside than 28%. The way I'm getting 28% is I'm taking the company's guidance of 55 cents to 80 cents for 2026. The company has a history, again, of under-promising and over-delivering. They're launching crypto. They're launching like cross-border payments and many different things. So I'm not seeing why SoFi is not going to hit 80 cents by 2026. Now, if they hit 80 cents and the current PE ratio is about 45 times earnings, it used to trade at 65, 68 times not long ago. It's trading at 45 times earnings right now. So we take in the 80 cents in earnings per share, and we time it by 40 PE. This is around $32 per share. The current share price is about $25. This is around 28% on the upside for SoFi in 2026 alone. And beyond 2026, I'm seeing much more than 28%. I put up the current earnings per share of 80 cents that's expected for 2026. After that, I put up 25% EPS growth and 25%, 20%, 20%. I think this is fair. The current PE ratio is 45 times. I put it at 40 times. Many of you told me 40 times is too high, but I believe the company will likely have much more revenue growth left ahead, and they will likely have much higher margins over the next 5 years as they transition more to a fee-based revenue business model. So if they do trade at 40 PE, I'm seeing $71 per share or 186% on the upside over the next 5 years with a bank like SoFi. Now, what if they trade at 30 PE? Which could be potentially possible. If they trade at 30 PE, then I'm seeing $53 per share or 115% on the upside over the next 5 years with an amazing company like SoFi. And by the way, I'm using Fiscal.AI to come up with those charts. So if you want to try it out, they give you 2 weeks of free access if you want to use my link down into the description. But I really like SoFi very much over here. I think it's undervalued. I think it would be too cheap to ignore. Close to $20 per share, but even 25, 26 to me is not overvalued at all. And it's one of the most interesting growth stocks at this valuation in this market. And the second one that I bought to dip on, and I haven't bought to dip in a while, is Hims and Hers Health. I started buying Hims at 7, then the stock went down like 42%, and I bought in at $5, I believe it was, or $5.55. And then I bought in at 11, I bought in at 21, and I just bought the dip about $36 per share, as I believe the stock is getting, you could say, too cheap to ignore. And there's a lot of drama around this one. It's a very volatile stock. It has had multiple 40, 50% pullbacks, 55% here, 49%, 30, 67, and then it bounces back 100, 200% out of nowhere, 41% just a few months ago, and this is another 47% pullback. Someone in my group told me that HIMS goes through 5 to 6 bear markets every single year because the stock has those crazy declines, but then it has crazy rallies. And as you notice the trend over the long term, the trend is up. So they do have those pullbacks, but it just keeps on making higher highs and higher lows. And I mean, this is a business. And if you focus on the business instead of the stock price, it's going to be a little bit easier. But HIMS, you could say, is a telehealth company. They're pretty much everywhere from weight loss, sexual health, dermatology, mental health, hormone health, longevity, menopause for women. This is a huge one that's growing rapidly for HIMS. They're also in Europe and they're expanding more into Canada in 2026. The company has suffered from a revenue decline the last quarter, and now it reaccelerated back in revenues, and we're on the right track from here. And many investors were worried that HIMS has declined in revenues, but that was due to them no longer mass selling GLP-1s. So they were mass selling GLP-1s in, you say, Q4 and Q1, and they made a lot of money from that because it was, again, on the shortage list. Now it's no longer on the shortage list, so HIMS cannot mass sell GLP-1. And for me personally, I'm surprised that HIMS was able to hold up 600 million in revenues without mass selling GLP-1s. I was expecting more revenue declines, but the fact that it just came back and is hitting 600 million to me is very, very surprising. Now, from a recent post on X, I said lab is HIMS AWS moment, and I couldn't be more excited about the future. The reason why I'm saying that is because HIMS and Hers has launched a lab platform where you can go and test yourself once a year, and or even twice a year if you choose to, for like $200 or $300. It's very, very cheap, and it will pretty much give you a game plan about your health, very deep analytics using AI about everything in your body and what you could do to improve it. And most of the things that you could do could be purchased from the HIMS and Hers platform. So this is gonna help the HIMS and Hers subscription become more sticky, as a lot of people will be testing themselves once a year or twice a year. They're gonna keep this subscription and they're gonna treat whatever they have to treat to remain healthy from the HIMS and Hers health platform. So I believe this is a game changer for the company. It's going to allow the company to reach more people, and it's going to allow them to cross-sell many different things and keep increasing the average revenue per user. So I really love this development from HIMS, and I'm very curious to see what happens. Now, to keep it short, because I always talk about the stock, with HIMS, I'm getting a founder CEO, large total addressable market, healthcare, over $1 trillion, 60% revenue growth, 75% gross margin, $1.1 billion in cash for an $8.8 billion company. This is more than 10%, like 15, 20% of the market cap is in cash, and I'm only paying 2.9 times sales, while Palantir is trading at like 100 times sales, and Duolingo is still trading like 15 or 17 times. And you have a company that's growing 60%, disrupting a large market with high gross margins, founder CEO, 1.1 billion of cash at 2.9 times earnings. This is extremely, extremely cheap. And this is due to two main reasons. The first reason is that HIMS was highly dependent on GLP-1s and weight loss. But HIMS right now is diversifying away from weight loss through the lab testing, through the Hers business, mental health, and other kind of menopause, and many different areas. Sexual health is becoming a big part of the HIMS business. So those areas are not as volatile as the weight loss business. And I believe as HIMS transitions away from weight loss, they're going to likely get a multiple expansion. Another reason was the potential lawsuit from NVO, but it still hasn't happened. And I always say that if the lawsuit wants to happen, it would have happened already. And now HIMS is potentially partnering with NVO. They're in discussions again with the new CEO of NVO, and things are going really, really well. So I believe those two things, once they are resolved, HIMS should not be trading at 3 times sales, at least 5, 7, even 10 times sales for such growth, in my personal opinion. But the company is still expecting at least 6.5 billion by 2030. So I'm going to take in the 6.5 billion. in expected revenues, always using 7 times sales and 10 times sales, as I believe 3 times sales is really too low for the business. But if I use 7 times sales, I'm getting a $45 billion market cap. The current market cap is not even 8 billion, guys. I made a mistake. It's around 7.9 billion. So dividing it by 7.9, I'm getting 475% on the upside over the next 5 years with an amazing company like HIMS with a lot of cash and an amazing CEO. But even if they trade at 5 times sales, we can take in 6.5, and we're going to time it by 5 times sales, which to me is the worst case scenario. This is a $32 billion market cap, and the current market cap is about 8 billion. This is around 311% on the upside over the next 5 years with an amazing company like HIMS. So this is why I bought the dip on HIMS and I bought the dip on SoFi, and I'm planning to buy much more stocks in this pullback, especially growth stocks. And if you're interested in what I'm doing, what I'm buying, what I'm selling, how to value growth stocks, and other videos I have, you could check out the link to my group here if you're interested. So thank you again for watching. Not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.